Morning.
George, how are you doing?
Well, I'm going to tell you a quick little story. So I started my day off. I kept looking at my watch, okay, and I had it stared at least I don't know 4, maybe 5 times because I kept saying that it was 22 degrees out. Today's April 22nd. I couldn't read my. I kept saying like, wait, what? And I was like, oh wait, no, today is the 22nd. It's not 22 degrees out.
Well, it was 30 degrees last night. So
Yeah,
we have been getting some good temperature swings.
yeah, but it wasn't 22.
No, not that good, but
Um, So, we were talking the other day and just thought we'd get back online about this one. Because one of the things that you and I have done is we have, so for those people who haven't, met you yet, Bill Bateson, of course, for those of you who are working with him, this is the face of the name. And one of the things that Bill and I talk about all the time is the fact that when people get pre-approved, that's really that's the snapshot in time when we're looking for a house. And then you have people who get pre-approved, and then things can happen, whether it
yeah.
be job changes, whether it be life changes. They have to put something on hold for a different reason, whether it be they're just not finding something that interests them, and time passes. And Bill, I think you guys usually issue pre-approvals for a period of time, and then they have to be redone anyway.
Yeah, your pre-approval is usually good for the length of time that your documents are good for, and the big document that expires for us is that credit report.
So is that
So
about 90 days?
yeah, it's about 90 days, or at least around the 90-day mark. We hit that. We know that if we go under contract right then and there,
Yeah.
maybe we could close before that credit report expires, but probably not. So it's good to start considering pulling another report. And
So if the time period of the credit report is kind of a way to say this is your window, this is when you're looking at that property and looking to go under contract, because once you're under contract, then you guys are going to be doing a recheck of things anyways when you're going through underwriting. You'll be doing second reviews
oh
on
yeah,
all that. But one of the reasons why this becomes important is what you and I talk about is purchasing power.
mm-hmm.
And any one of those changes, whether they be a life change, whether they be a job change, whether they be activity in the market, whether it could be stuff like what we're seeing right now, where we have inconsistency right now in the inventory level of the market. Some towns are booming right now, more than enough inventory is coming on. Some towns are still sluggish. It all depends because on town demographics and size. So, but anyway, when we talked about it, you keep underscoring the fact of we got to pay attention to their purchasing power. Can you explain?
Yeah, because it's a moving target, and it's always a moving target. As we've harped on again and again, taxes make a big difference.
Mm.
At the end of the day, what people have to understand is they're pre-approved for a payment. We don't pre-approve for purchase price. We pre-approve for payment. So if you're pre-approved for a $1,500 payment, whatever mix of purchase price and taxes and homeowners insurance it takes to get to that $1,500, that's what you would be pre-approved for. So, you and I talk and we get a general sense of, okay, well, this translates roughly to this purchase price.
Yeah.
But I've had properties where the insurance ended up being $3,200, a year on a property that I was assuming it was going to be $1,200.
Mm.
That's a good $150, $200 a month in difference in that payment. That makes a big difference.
So let's take that as an example in that case. So in that example, we would have been under contract. We would have gone through inspections. We
Had
would
the
have
appraisal
made it
probably.
through the appraisal at that point in
Yep.
time. Title search would be underway because homeowners insurance, most buyers don't start shopping around for an insurance policy until 2 or even 3 weeks before a closing
Yep.
date. So what happens at that time? How do you guys usually try to work through that then?
At that point, we scramble. So I think for that borrower, I think what we ended up having to do, like I said, it's a moving target. When we had pulled a credit report, there was some credit cards that had monthly payments, I think that were around, $150 because there's a big balance on it. So when I qualified her, it's, said, hey, this is great. We don't have to pay any of your current debt down to help you qualify. I think we ended up having to pay debt down. And I think we ended up having to shop around the homeowners insurance to try to knock an extra $800, $1,000 off of it. So, you start scrambling. And that applies for homeowners insurance. That applies for if you're, as you said, we're talking about credit reports, pull a new credit report, and you have new debt on there. You have higher debt than what we were talking about 2 or 3 months ago. I've had people apply for loans 3-4 weeks before closing. I've had someone apply for a loan a week before closing and it showed up. Things like that can change. But, in this market, I think the biggest thing that we're talking about is the rapidly changing nature of home prices and interest rates, right? I think that was mostly what we were talking.
Yeah, that is a big part of it. But and I do want to come back to that, but there's a point you just made there. For example, you're talking about people who basically changed their normal pattern during the closing period. So a change in normal pattern is they decide to go out and open a furniture account at a store.
Yep.
And now they have the home improvement stores, a furniture store, they go out, they open the accounts because they're thinking, hey, I want to be ready for when I close. I want to be able to go out and buy those things or do those things.
Yep.
And what they're not realizing is that they got a $10,000 credit line at a furniture store, $5,000 credit line at a home improvement store, and those are easy to get. Those are not
very easy.
And all of a sudden now you're looking at they've got $15,000 worth of open credit sitting on their credit score, and that changes the ratio, right? So it may not be utilized credit yet, but the fact that it exists is something you then have to take into account. So that is actually an example that comes up more frequently than probably anything else. But your point earlier, and now this goes to what we're seeing where you have the volatility of price. Your point earlier, though, is that if we're looking at a payment, let's call it the $1,500 payment, which incorporates principal, interest, insurance, and taxes. Mm-hmm. So a great example, you and I were talking yesterday about that couple I'm working with who's moving from California to Connecticut.
Yeah.
And they're looking in some very specific towns because they want to be close to school system that their kids are now enrolling in. So the towns that they're looking at, though, one town has, comparable homes. Okay. About 4-bedroom, 2.5 bath, 2-car garage, half-acre lot, that kind of thing. Okay. So kind of a comparable home between two different towns. One town, the taxes on this one town were roughly about $7,000. Same price house. Okay. Houses were about $25,000 in difference in price. The other town was almost $10,000 in taxes. Okay. So you had like a $3,000 swing on just those two properties. All right. There was actually one that was more extreme than that. It was almost a $7,000 difference.
Eesh.
So that's going to change, though, that purchasing, that pre-approval, what they have as a monthly payment, that's going to change what they've been approved for. Now, they're not working with you in that case, but that's a good example, though, where price is about the same, but it became irrelevant because the taxes went up so much on that one house.
Yep. Yeah. And that's, so a $3,000 swing is $250 a month in extra payments. A $7,000 swing is $583 a month. So if we were expecting that, let's say the 7,000 mark, and the taxes ended up being $1,400, well, now that $1,500 payment that I thought I had you qualified for is $2,083.
Right. And now
there's a lot of scrambling.
Right. So now this is that now, and the worst part is when you find that out under contract.
Yes.
Which is part of the reason why we always talk to people about, let's pay attention up front to knowing what the price is, but what is the tax ceiling that we want to be at, because that's what factors into more than anything, right?
No, absolutely.
Interest, taxes, those are the three things that really, really affect that monthly payment amount. So now we get into price volatility, right? So we may be looking in a given town. So we have buyers who are looking in, 1 or 2 towns. That's their preference. We know their style house. We know what they're looking for. We know the price ranges they're staying in, and we know the taxes on those towns. But now they're dealing with, prices moving this way because they're looking for move-in ready, nothing to do, almost HGTV level type housing.
Yep.
And so what they're seeing is the market, kind of hurt them a little bit because sellers can command a price right now. So this is where, as those prices are going up, the taxes are staying the same, but they're losing that purchasing power because of price.
Yep.
Right?
Yeah.
Is it price or is it rates and price?
Well, it's the mix. So if rates were stagnant, so a $10,000 difference in price comes out to about, let's say, $10, $5 a month in payment difference. So if rates stay stagnant and prices start rising, then, you're having that conversation of, okay, am I comfortable paying $5 more per month? Can I offer, an extra $10,000 over list, and can I pay $20 more per month? So you're having that conversation, but now also, you mix that in with the interest rate volatility, and it's volatile right now. It is such a straight line up, pretty much. It's a rocket up that we've seen in rates. So that is the bigger moving target right now, I think. I'm not sure you can maybe speak to price stability right now, but I know as far as rate stability goes, we ain't got none.
Well, so we're dealing with the fact that we have two things that are increasing: price and rate. Rate is more steep than price right now by a long shot. Prices have started to, the rate of increase has softened. Increase is still occurring, but the rate of increase is still softening. And I can tell you, there's one in the town. Hamden is a town that I do a lot of work in, and I was looking at home prices in Hamden the other day, and you had a house that was a 3-bedroom, 1.5 bath, 1,500 square feet. As typical as it gets, was pricing at, call it, $300,000.
Yep.
Back in January, that was pricing more like $280,000. Okay. So we saw this huge gain in the first quarter. Well, coming into April, we're seeing now that price has gone up to, now it's maybe not 300, maybe it's 305. So the rate of increase is still there, but the rate of increase has lessened. Compared to start of year, it's still up, but compared to the prior month, it's not up as much. It's not as steep. But interest rates, the way they're going, what it's doing is it's taking the buyer who's looking at that $300,000 house, and they're now down to $280,000.
Yeah. Yeah. So
now,
that $300,000, I'm doing math to the side. That's why I'm looking over here. The difference between a 4% rate and a 5% rate on $300,000 is $178 a month.
That's not insignificant.
No, it's not. But we're also going from 5 to 6% as well. We're closing in on 6. That's another 188. So now you've got, you combine all the things we just talked about. So principal, interest, taxes, and insurance. Let's say we don't do all of our due diligence up front. Taxes scare us. Whoops, there's $300 extra a month. Insurance surprises us. Whoops, there's $200 extra a month. Interest rates went up. Whoops, there's an extra, $250 a month. Now, that $1,500, if we weren't watching it, $2,250.
Yeah, and the worst part is when you're finding that out under contract.
Yeah.
So this is where, we talk to people all the time, and probably the one thing I want to underscore more than anything on this theme is staying connected with you is just as important as talking to me about how that home search is going. Because, I talk to people every week about, some people it's every day because it depends upon how aggressive we need to be because of their situation. But we have some individuals who, they're like, yeah, I have to talk to Bill again. I haven't talked to him in a month. And I'm like, you might want to be in more communication with him for right now, because again, yeah, I know the price we're talking about. I know the area we're talking about. And again, taxes aren't changing because we're staying in an area, but price is changing a little bit. Again, not as severe, but if the rate has gone up for that particular buyer, because rates are market, but then they do come down to the buyer's situation. Correct. Mm-hmm. Right.
Yeah. Yeah. And they, in punishing times, interest rates tend to be more punishing on those who aren't the perfect borrower. So if your credit score isn't tip top, if you don't have that big down payment, So
what you're really talking about there, you're talking a lot about your first time home buyer loans.
Yeah.
Commonly referred to as FHA.
Yep. Yeah. Unfortunately, now we've seen some movement in FHA rates in a way that, if you don't have, that higher credit score, you're getting that 6% rate, or you're going to have to pay points or something like that. It all depends on the situation. But we're seeing some of those things now in rates because there's so much uncertainty that, frankly, when you see some movement like that, it's investors saying, listen, I don't know what's going on.
Right.
I don't know how to set a rate right now. They're almost saying, I don't really want these loans right now because I don't know what the future is going to hold. So I'm going to, it would be like if you're a plumber and you go and you look at a job and you're like, this job is so complicated. I don't even really know how I'm going to approach it. I'm just going to throw a price at it. And if they, want to do it, then perfect. I'm going to make sure I'm covering all my bases.
Right. You made the comment about some investors are saying they may not even want the loan. I have been running into that more and more frequently over the past, I'd say 3, maybe 4 weeks, where we've been talking to. So I have, obviously not everybody I work with works with you, but those lenders that are representing them, I've talked to those lenders, and there's a hesitation in their voice because it's their ability to manufacture the loan at a reasonable enough rate that they can then still resell to the secondary market, because a lot of those originators don't keep the loan.
Yeah.
And that has been actually affecting the 30-year fixed rate conventional loan buyer. I've seen them more affected than some of the FHA buyers. But I understand your point, though, about the fact that if somebody isn't in that, call it tip top situation or condition for credit score, they're going to see more volatility. That said, this isn't a permanent thing. We're not going to just continue to see rates go like this forever and a day. The Fed made its announcement yesterday that they're going to do the 50 basis hike. So that's called a half point as of May. So, and there's still calls for that to happen at least 2 or 3 more times before the end of the year. That doesn't necessarily directly translate, though, into mortgage rates going up 0.5%. And we have another video where we talked about that.
Yeah.
And I think that's another point, is that what people have to understand is pay attention to what the market's doing in price. Stay focused on the type of home that you're looking for, so what that tax ratio, which is so important, okay, is going to look like. It's actually not a bad idea to go out and get some quotes on home insurance right now.
No.
I have one buyer who actually did that first because they wanted to find out what's it actually going to cost me. I thought it was fantastic. But
yeah, it's a smart move.
We're not going to see this. It's not going to be a permanent increase, is my point. Just like pricing is not a permanent increase. There will be a pullback. Things have a natural cycle. You see dips and valleys all the time. But I think what we're going to see for interest rates is, this is my guess, far better than I do. My guess is that we're going to see rates continue to climb into June and July, and then they'll probably...
Yeah, most likely.
It wouldn't surprise me if they kind of correlate with the peak pricing period that we see on home sales. Because June is typically the peak of the year for pricing, and then we see pricing start to come down a little bit as things cool off. I'll make another speculation. If this summer is the summer that people can decide, well, I don't have to travel without a mask, we may see travel increase. Guess what? If people are taking vacations, they're not buying houses.
Nope.
So sellers will see fewer and fewer buyers in demand, and that may soften sellers' stance on what they can put as pricing. So there's a lot of what if, but I think it's important that people, number one, stay in touch with you. I cannot underscore that enough, because you don't want a surprise. You don't want to go under contract, because I don't ask anybody, what is your financial situation? I don't ask them, hey, how much money are you spending? I just need to understand what it is that you want to accomplish in a home. What is it that you're looking to secure? Because if the financials are with you, that's what they cover, or with their lender if they're not working with you. But it's important that they stay in touch with you guys.
Yeah. I think, when times are uncertain or volatile, that is when you got to be either staying in constant contact, or once we talk, get out there and get it done.
Yeah.
We would have this reverse conversation if prices were falling and interest rates were falling. I think it would be the same thing. Now, nobody likes it because of the way that it's going. Interest rates are going up and prices are going up a little bit. There, the acceleration is starting to come down a little bit. But it would be the opposite conversation where, all right, I'm looking at this home today and it's $350,000, but they just dropped the price to $340,000. And I talked to him. I'm like, well, you know what? Actually, your rate just dropped 0.5% as well. Now you can qualify to 400. Did you see any homes in the 400 range that you liked? People would love it at that point. But it would be the same thing, as we would have to be in constant contact.
Right.
And again, as I said, if you're in this market to not just this market, if you're in it to go and purchase a home and you're ready, you and I have seen with plenty of clients, there's success to be had.
Oh, yeah. I mean, there's a couple that we're working with right now that just recently went out of contract. I mean, I wish we could say their names because they killed it.
Oh yeah.
They just so well prepared, stayed on top of everything, aggressive. I mean, aggressive on the showings. I want to say we looked at roughly 14 or 15 houses. I'm forgetting the number now. But if I look at my files, we probably put in 6 or 7 offers and they got it done. And the most important part is they did not spend beyond what they wanted to.
No, actually under.
That's right. You're right. They did go under. And the house doesn't need any work. It's all those kinds of things. So the point is that when you're committed to something to get it done, then you get it done. And I think the best way to get it done, though, is to stay in touch, not just with me through that process, but staying in touch with you. Because you just said something else about if prices are falling and rates are falling. Well, in those cases, I'm going to disagree with something you said. I don't necessarily say, well, let's go see if we want to ratchet up the price range to see what other inventory is there. Because if that's happening, I'm looking at saying save the money.
Yeah.
You're buying a house for term. You're going to get more out of that house because if the price is coming down, then over time, that price is going to go, the value on that house is going to go back up. You can have that equity in the house. If you sit on that house for that 10-year period of time, you're going to have equity in that house. So we're big champions of that, of course. But
oh yeah.
All right. Hey, listen, so I've got to run here in a minute, but a few other topics I wanted to just kind of tee out there to give you food for thought on. All right. So one of the things that I'm starting to see more and more frequently also are the types of loans that people come in with. CHFA, we talked about this once before for Connecticut buyers.
Yep.
CHFA has been getting more and more activity, and I'm seeing more and more listings coming with it. So I think that's something else to circle back to is just, are there different criteria? Is there different qualification? Is there different things people need to know? Because we had some people who went in with CHFA, and we had to get a little creative with how we address that.
Yep.
The other thing, conventional loans as a whole. Because of that comment you made about the fact that there are some lenders who are saying, I'm not sure. And then the last thing is just, I'd love to hear your thoughts. Another time, I'd love to hear your thoughts on where do we think this is all going with the Fed and interest rates? What should we be anticipating? And almost kind of profiling it by maybe 2 or 3 types of buyers. Somebody who's in that real entry level position. I don't mean price, but position as a first time buyer. Maybe they're looking at even a condo, for example.
Yeah.
So they're in a different pricing range. And condos are brutal right now. Because there's nothing that's FHA approved.
Yep.
And then maybe we just get into other types of buyer profiles. But those are things I would love to catch up with you on. And then we have a whole list of topics that
long list.
Well, I'm getting questions from buyers all the time.
Oh yeah.
And I'm trying to keep track of all those so we can do this and just kind of try to answer those questions. But any last parting thoughts on the whole rate adjustment or rate and price adjustment? Anything there?
No, I mean, it's just things are volatile right now. We're waiting for what we would call some ceiling or a sideways time where rather than rates going up, they're just kind of stagnant for a little bit. And every time we think we get that, they keep kind of punching up. So it has to come soon. They cannot rise like this forever. I've heard people throw out, a 6% level is maybe where we're going to go. I've heard people say a 7% level. The big thing is not necessarily these Fed rate hikes. The big thing is going to be what the Fed ends up doing with their balance sheet. Right. So once we get clarity on that, I think that will be the event, or something to do with Ukraine, something to do with Ukraine and Russia and how that's going to, really end up. That might be the thing that sets our ceiling as well. But I think it's going to be balance sheet related for the Fed. And that's a whole other video.
That's a long topic. And that, I'll be honest, that's going to be outside of my wheelhouse if we get too deep into that one.
Yeah.
All right. Hey, there was one other thing I want to touch on because you talked about, and this is a topic for another day, not for now. You talked about, how rates may hit a ceiling. Let's say it's 6.5%. Let's say it even gets to 7%. Well, a topic for you to touch on later on is, when's a good time to refi? Okay, because you have buyers that are coming in, and it's depending upon the loan type, okay, and how much equity they have in the property, that's going to help influence the timing of when they can do a refinance, right?
Yep.
But then you also have the topic of, well, when do you? And I can tell you that on the ownership of my house here, I think we did 2 refi. I think we did it twice. Maybe 3 times. I'm losing track. But there's no limit on it. There's
No.
no method to it that you have to say, well, I've hit this point, now I'm required to do, or hey, so that's a topic for another day that I would love to get into, because there are a lot of buyers right now who are sitting there saying, oh, George, I can't afford 7%. Well, but is that a short-term thing, or is that a long-term thing? Because we know there's going to be rate adjustments. We know that there's going to be adjustments down. Even back when I bought this house and we were paying double-digit interest rates, again, our blended rate at the time we purchased was 13.5%. Okay, I bought this house at 13.5%. That you want to talk, and
I don't think we're going that high.
No, but everything's relative, So the income level was relative to the time and all that.
Yep.
Interest rate was punishing though, and so I think the first year, we scrimped and scraped our way through everything. But anyway, we'll come back to that another time. But I think refi is another great topic for you.
Absolutely, I am getting that question all the time, so that would be an excellent one to touch on.
Okay. And then we'll have to go back and redo one of our other sessions on the national versus
we're learning
hyper local.
Hyper
local. I got to remember that term. Hyper local. What is the hyper side of it though? I mean, there's local, there's neighborhood.
It's like concentrated. It's hyper local.
Yeah, but Bill, at the end of the day, it's a neighborhood.
I've heard this term. I don't think it was my term. I think I've heard this from some other, it comes from when Zillow and there's still actually plenty of companies that are trying to do their just kind of iBuyer thing, where they just make offers and they think that they know the local market. But, it's so local. It can be, if you purchase the same exact home on this street and then you go over 2 streets and it's again, the same home, and you think, yeah, well, I'll just buy this one for $250 and this one's also worth $250.
Yeah, but
totally wrong.
That only really works though in markets that are since 1950, 1960 developed markets.
Oh, yeah.
Where you have everybody's in a pre-formatted house. So it's a manufactured community for all intents and purposes. Maybe it's even a gated community.
Yep.
Where houses are literally, you can walk in and you could be blindfolded and walk into the next 3 houses and know the exact same layout. I mean, that's where the quote unquote Zillow iBuying program was trying to succeed. It doesn't work here in New England because every house is theoretically different. I mean, on my street alone, I live on a small cul-de-sac with 10 houses. There's not one house on this street that is laid out the same as any other. And that's not just because of when it was built or how it was built, but it's also because people make changes over time. Right?
That's the big one. Yeah.
And that's where, and as a side note, and this is another topic that came up yesterday. So the calculation of payments on Zillow. Okay. Somebody said to me, they said, George, I looked on Zillow and it said my payment was going to be this amount of money. I'm like, I said, but did you change what they have as the preset conditions for 30% down payment, for $20 a month in insurance? I'm like, those are not realistic numbers. Those are meant to draw you into taking an interest in buying a home that maybe it looks like you can afford it, but you actually can't because, again, of those settings that are preset in the app. And then the last thing they were asking was the tax payment on it and whether or not that is a calculated tax payment. I said, well, that's public data. That Zillow does not in any way, shape, or form calculate that. They're taking what is public data and dividing it over 12. So
they still don't use, I still don't think that they use the actual tax data.
They're pulling in the public data.
Well, I know that they're pulling it into the listing, but are they pulling it into the calculation?
Yeah, for taxes, they should be.
Oh, I thought that I've looked before and it was just an estimate.
No,
I could be wrong there. I mean, geez, you hope that they're.
No, they should be. They
have the info right there.
Okay, so now you've got me wondering if that has changed now, because what it's supposed to be is that they're pulling in the public tax data, because tax data is publicly available. It's through the assessment history and everything. That's in the tax record that they're pulling, that even pulls in the property details. So they know the parcel ID and everything else. So it should be attached. That there's no reason that they should be doing an estimation. They may call it estimated because taxes can be adjusted on assessment year over year. So they can't say this is a fixed amount.
Yeah.
But it should be based on, and maybe within a couple.
I hear a lot of shoulds in this sentence about Zillow.
I'm not going to deny that. I'm now sitting here. The back of my head is going, oh my God, what if they are just creating a calculation? I'll have to go look.
Listen, I could totally be wrong, but I'm probably wrong, because why would they not? the information is right there, and you just simple calculation, divide by 12, bring it, boop, boop, boop. But
they may have to label it estimated because of the fact that you can have year-over-year changes in taxes, and so they can't say that it's a certain specific amount because you could have a timing differential. You can also another reason why they can use the word estimated is because at the time of close, it's prorated to the day of the month of the closing, and so what you're paying for taxes in the first year is not going to be specific to the calendar year unless you bought specifically at 12:01 a.m. on January 1st of the given year.
Yep.
So I'm going to take more confidence that I don't need to say should a lot.
All right. Confidence in Zillow. I like it.
But you got me seriously. I mean, it's all of them. It's not just Zillow. I mean, Realtor.com, what truly is owned by Zillow, Redfin, they all do the same thing. They all pull in the public data. This is a whole other topic we could get into another time. Yep. But they all pull in the public data. It's the same public data that I pull in. Okay. If I go and I look up tax records, if you go right now, so here in New England, a lot of towns use what's called the Vision system. So if you if you type in, you live in, let's say, town of Cheshire where your office is. Okay. So if you type in Vision GIS Cheshire, it's going to pull up a link and it's going to be the Vision system. You click that, you type in the property address, and you're going to see the parcel. You're going to see the property card, which is going to have on it the assessed value. That's how they're calculating the taxes. That is the town record because every real estate transaction is public record.
And then Connecticut uses my tax bill a lot. So if you type in the town and the term my tax bill, you can usually find the tax website. Again, this is all public data. You type in the parcel, you can type in the owner's last name, whatever you know, and you can find the tax data.
Yep. You can find the last sale history. I mean, again, real estate, because real estate is a public function, it is publicly available data. And a lot of people don't understand that everything about real estate is recorded and made available for anybody to review, it has some risks to it that everybody gets freaked out about. But at the end of the day, it's a whole other conversation. I could go on for hours about that.
We're spinning now, right?
All right, hey, listen, I got to run. I know you do too. We kind of went off on tail side here, but listen, I appreciate it. So the main thing to underscore again for everybody, stay in touch, not just with me and talking about, hey, George, what about this house at 123 Happy Lane? But talk to Bill. What about this house at 123 Happy Lane? Because you may say, hey, that's a great house, but we need to make some changes. Or, nope, you're still in the sweet spot for that. Go get it done.
Yep. Yeah, absolutely. I'm not even going to add anything. That's 100% correct.
Cool, man. I'll catch you later.
All right. Take care, George.
All right. See you.